Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for August 10th, 2020. Please see our disclaimer for important information. So our comments this week will kind of focus around kind of this post earnings season lull that we've got now in front of us. We know that the election is just a few months away. Typically, we see a little bit more volatility in that, but it's time to kind of take stock of where we are. Perhaps spend a few minutes on the labor situation, but let's go ahead and jump into it, shall we? So, markets over the last week continue to grind higher. Now we've had second quarter S&P 500 earnings reports, which have been really less bad than we expected. And so, the earnings year over year are down about 33%, but before the earnings season started, they were estimated to be down somewhere between 45 and 50%. So not as bad. The S&P last week was up 2.5%, as was the NASDAQ index. Dow Jones was up 3.8%. And if you look over the last quarter, which would be from adding July into the August to date, the S&P's up about 8%. The Dow Jones is up about 6.3, and the NASDAQ is up about 9.5. And for the year to date, we continue to see this momentum in the S&P, having battled back from persistent losses dating back to that torrid decline that we saw towards the end of the first quarter. The S&P, as of the end of last week, was up 3.7%. The Dow is still down about 3.9%, and the NASDAQ is up about 22, almost 23%. And small caps, as defined by the Russell 2000, are still down also about 6%. The international index, which I'll kind of define as the MSCI EAFE, or Europe, Africa, Far East, it's down about 9% year to date, but it is positive for the month and up about 4.2% for the quarter. So that's very positive. We're beginning to see some tandem movement in some of the international markets. But if you look at in the fixed income side, the Barclays aggregate index is up about 7.8%. So we continue to see outperformance of bonds relative to stocks, particularly the longer dated maturities, but not sure how much further rates have to go from here. We'll talk about that in a second. So the benefits to the fixed income returns from capital appreciation, I think, are going to be fairly muted going forward. High yield is now positive for the year, up about 1.2, 1.3%, and the loan market is still down about 2.3% for the year. So obviously we've had a tough time in the real estate markets, although ironically, quarter to date, the Dow Jones U.S. Real Estate Index is up about 5%, and although it's still down about 9.5% for the year. Commodities rose for much of the week, and prices for crude were up about 2.4%, holding about $41.22 at the end of the week. And so we've seen, at least for the quarter to date, about a 5% move in crude. We've seen almost a 28% move in natural gas, as the hot weather is generating a lot of gas-fired cooling demand. But both of those markets are fairly tepid for the year, natural gas being up slightly for the year. And then, just in terms of overall interest rates, we saw a lot of movement in the 10-year Treasury, which dipped down to near a low that could have only been matched by what happened in March, but we dipped down to around 50 basis points, or half of 1%. We ended the week at about 56 basis points, and that's down 1.35% from the beginning of the year. And we've seen an even greater move in 3-month LIBOR, down about 1.67% for the year, down to just 24 basis points. And even the 30-year Treasury is ended the week at 1.2%, which is down almost 1.2% from the year. So, we have continue to see the positive movements in the equity market. And just we've seen 82% of companies have topped their forecasts, and that's above 71% average during the last 4 quarters. Now, granted, that these earnings estimates were managed down so greatly that it really wasn't that hard to beat some of these aggressively kind of almost depressing level earnings estimates. But and then on the fixed income side, we've had a turn for the negative in real rates at the end of January, and so we've seen real interest rates, is defined by the 10-year Treasury real yield, is now down about 70 basis points to about negative 1.1%, and so that's driving that in a weak dollar, which is down roughly about 3% year to date and about 4% over the last 6 weeks. That's driving a lot of interest in gold. And so, like if you look at the commodity basket, you've got a real bifurcation between crude, which is struggling, even though crude prices have bounced back. But then you've got gold and silver, which have really taken off like a rocket. So we've got some comments there. So economic review. So we had a good jobs report. We had 1.76 million new jobs added, and the unemployment rate dropped from 11.1 to 10.2%. So even though we've lost 22 million jobs from March to April, we've regained about 9.3 million jobs. And again, the jobs that have been gained have been fairly low wage in some of those service sectors, hospitality, restaurants, so on and so forth. But we had a week filled with largely positive data. The Institute for Supply Management, Manufacturing, and Non-Manufacturing Sentiment Indices rose more than expected. So, I think really as we sit here now, we've got a lot of eyes that are looking at the high frequency indicators and also at the next round of fiscal stimulus, which has become a huge political football as of late. So the high frequency indicators like TSA checkpoint data, mobility information, gasoline sales, truck loadings, and freight shipments, and those types of things. Activity began to decelerate with the rise in virus cases. Now we're maybe seeing a little bit better data in terms of the pandemic. But that data, that progress that we saw in the high frequency data has that significant progress that we saw like May into June kind of waned a little bit in July, and we'll have to see how August shakes out, given that we're only 10 days into the month now. But one can hope that we can be a little bit to be in a little bit better shape. But just some observations in the market. Obviously, U.S. and China, that situation continues to deteriorate. Now we have yet another salvo coming from some of the restrictions and things that have been done by the Chinese government against some of our domestic politicians here. We have more crackdown in Hong Kong for opposition voices for democracy. So there's a lot of rhetoric, and I see that both of them are basically, both the U.S. and China are basically stuck in this Cold War now, and that hostility towards China is growing not only in the GOP but also in the Democratic Party as well. And that comes at the same time that the data seems to be clear that President Trump is in a deficit for his re-election prospects. And so that is, I think that there's a conventional wisdom, whether you want to ascribe to it or not, that if Joe Biden were to win the presidency, and then you also had a Democratic sweep, if you will, them having taken the Senate as well, that would be a less market-friendly type of an environment. And I think the prospects of that as we get a little further along could create some turbulence in the market. But again, the labor market continues to strong recovery, and kind of a tangent to that, the manufacturing hours were up about almost 2%. Corporate earnings, even though they outperformed, they still remain under pressure. Like I said, the actual number is like negative 33%, and I think the earnings are going to continue to be under pressure. And with stock, with valuations for equities already at high levels, eventually weak earnings is going to catch up with stocks, I think. Stock market breadth is narrowing a bit, which is typically a negative sign technically, but I think there's still a reasonable prospect of some type of correction amongst this narrow leadership to kind of bring us back in line before I think stocks may be able to go a little bit higher. But having said that, a weaker dollar should continue to help non-U.S. stocks. It should continue to help domestic firms that have a lot of export-related revenue exposure, and I would certainly expect that to continue. And that I think will, and the fact that we're not going to have much of a movement in interest rates. I think the Fed has maintained a very strong stance that they're going to keep rates low for a long time. And even though we really don't have inflation, because of the decline in activity has kind of put downward pressure on it, and the fact that we've had supply disruptions that are causing the price of some goods and services to rise, but the pressure on the upside has been more than offset by downward pressure driven by weaker demand. That I think what it tells us is that we're not going to have much movement in these negative real rates, and that's going to cause, I think it's going to influence capital flows, and I think it's going to continue to drive interest in commodities, and perhaps gold is an alternative to fixed income in some cases. With that, might want to look here for a couple minutes before we conclude at the labor market. Obviously, we've got the President Trump jumping in with some executive orders which are already in the process of being challenged with regard to extending some of the benefits. I think there's a groundswell of interest on the part of some GOP legislators that there's a lot of the stimulus money that really hasn't been deployed. If you think about different types of programs that are out there, and not all those dollars have been disseminated into the public yet, that there's actually some reluctance. That, coupled with the fact that the stock market is fairly high, I think there's a reluctance on wanting to cave to a lot of negotiating pressure to come up with a deal. But I do think there will be a deal, and it looks like all indications seem to suggest it'll be somewhere between maybe 1.5, perhaps 2 trillion when it's all said and done. I think by and large both sides don't want to be the party of no, and certainly having mentioned President Trump's re-election prospects being impacted by the coronavirus, that there'll certainly be a lot of motivation to open the checkbook for that. But real quick on the labor market, so we're at the payrolls are still about 8.4% down from the February peak, and that's about 12.9 million jobs. We know that 30 million people are receiving jobless benefits as of mid-July, and that some of the higher frequency data kind of tend to point to weaker market conditions there. We did add 1.8 million jobs in July, so again, we've added 10 million since April, and which is roughly 40% of the jobs that were lost during the February-April timeframe. But the recovery remains fairly uneven, with some sectors really not seeing a whole lot of improvement. We know, as I mentioned before, that that we saw 80% of the gains in private employment in July were from sectors that accounted for about 33% of pre-pandemic private employment. That includes retail, restaurants, bars, hotels, things like that. And employment in these areas was up about 3.5% versus almost flat for the rest of the private sector. So we know that part-time employment was up about 3.5% in July versus about 0.5% for full-time. And we've seen basically from February to April, almost all of the 17.3 million increase in the number of unemployed were from people that said that they were on temporary layoff. And from April through July, the number of people saying that they were on temporary layoff is down about 9 million, and about 3.5 of them have re-entered the workforce. We have 5 million more people counted as employed with an unpaid absence versus normal right now, and the number of employed but absent workers has returned to pre-pandemic levels actually. So, but the danger is that we've got ongoing state and local retrenchment, which is a big source of contention in the current set of negotiations up in Washington. And we've seen a lot of layoffs coming out of state and local government. And I think the real risk is that when the assessment of what's going to wind up in the coffers comes to light, that you're going to see more purging from the municipal employment sector. So that could clearly be a headwind for labor. But it's just sitting here right now, it's hard to think that we were at a 50-year record low unemployment rate of like 3.5% in February, and then we were at 14.7. The good news is that we're, like I said earlier, like a shade above 10% now. So directionally, it's going the right way. But I think there's a disproportionate impact to lower paying jobs in all of this that we're just going to have to factor. And it's going to take us time to kind of rehabilitate our workforce, if you will. And the job losses have predominantly been in lower paying jobs, and it's putting a lot of people on the street and kind of beholden to stimulus programs. And so that's why there's such a risk in terms of the consumer spending, which we know a lot of the pickup in this consumer spending off the trough has actually come from people that are receiving stimulus checks, that are receiving this additional unemployment benefit out of the CARES Act. And so if that were to stop, then that would obviously have an adverse impact on our spending. But in any case, I just wanted to pass along a little bit of perspective on the labor market. We have a lot of good information on various things like gold and market valuations and such in our charts of the week sister webcast to this, so I urge you to go and take a look at that. But in any case, there's there's still an attitude, kind of to conclude here, there's still a distinctive attitude of everything kind of being hunky-dory despite the risks on the margin. There's this, what they're calling the TINA, which is there is no alternative to equities, in addition to the FOMO, or fear of missing out. So we've got, I think we run the risk of being a little bit overly optimistic. And the good news that's now being priced into the market, I feel, is bringing the market valuation to a fairly stout level. In fact, the S&P 500 forward PE ratio reached its highest level since 1998 last week. And if that's any indication of, I guess, the need to just have a little bit of caution, I think that certainly is it. So again, policy support remains critical. And we've been talking about this weak dollar and surging gold prices, and those are sometimes, often associated with rising market volatility. So those are things that we're going to have to watch heading into this election season, and pay attention to, because volatility could pick up here over the next few months. But in any case, that's really about all I've got this week. So I hope you've enjoyed Market Minutes, and we hope to see you again next week. If you have any questions, comments, please direct them to me at the information you see on your screen. Be safe, and we hope you have a wonderful week.